Happy Friday, everyone. Jason Jacobi with Boyer Financial here. Just wanted to jump on and give a quick little market and economic update. It's been a little while. Mark and I will be getting back to the normal podcast here shortly. So just wanted to briefly touch base before then. And it's Friday. So happy Friday again to all of you listeners and viewers out there. So it's been an interesting week or two in the world, to say the least. We had the Ayatollah in Iran taken out, along with over 40 of his top associates. So you have turmoil in the Middle East. You have inflation numbers that appeared a little bit hotter this past month than was expected. And you have a midterm election year. And on top of all that, we had the job numbers come out for this past month, and over 90,000 jobs approximately were lost this last month. So there's a lot of uncertainty, a lot of turmoil. So I just want to get on here and talk a little bit about kind of big picture, macro. We'll kind of start with the Middle East conflict, what to look at, what to watch out for, and my personal thoughts on that and how it affects our clients' portfolios or financial plans. And then we'll kind of go into some keys to investing in 2026. I think it's important to touch on that as well. So at the time of recording here, around Friday midday, we have the Nasdaq down almost 1% for the week. We have the S&P down over 1.7 for the week. We have the Dow Jones down 3% after a nice rally that it actually had to start off the year. And then Russell 2000 is down almost 4% for the year. Now, if we look back year to date, so obviously that was last week. If we look back, about the last 2 months and change here, Russell 2000 still up over 2% for the year. Dow Jones down 1, S&P down over 1, and the Nasdaq down the most, almost 2% down for the start of the year as of March 6th at around 11:50 a.m. So what to make of it? Well, again, guys, we talk about this all the time and we sound like broken records, but we do not know what markets will do in the short term. If there's anybody that tells you that they have a crystal ball and know what's going to happen, they are lying to your face. Okay. So, we don't know what's going to happen in the short term. I'm going to tell you this, that every pullback or correction or bear market that we have are opportunities to put cash to work. Again, you could have cash sitting under your mattress, but you're losing value over the long term because of what? Inflation. You could have it in a money market account and earn, roughly 3 or 4%, depending on the bank and what type of account, high yield or money market or, short duration bond fund, whatever it may be, right? There's different ways to put cash to work. It doesn't have to be a risk on asset, to say the least. So why am I going with this? Again, the world is digesting all of this uncertainty. If we're looking at the markets today, I'm looking across the world here, the global markets. Every country that I'm looking at is down with the exception of China and South Korea, which are both up over 1% at this point. But everything else, again, digesting what does the rising cost of oil mean for their economies. Obviously, the longer that this war takes to come to conclusion, the potential for higher inflation that we do have. Don't quote me on this, but I believe that, the longer we get out from solving this issue here in the Middle East, could add about 40 to 80 basis points to the inflation readings. Again, as we kind of get into month, 2 month, 3 month, 4 month, and so on and so forth, it can compound pretty substantially. Now, in terms of oil prices, if you look at 2025, oil was down 21% from its highs. So that was a great thing. Obviously in California, not the case. Highest gas tax in the nation and then some. But in terms of the national average, it was pretty remarkable. We're almost down by a quarter for oil prices. Now in 2026, different story, right? We were sitting at about $60 a barrel not too long ago, a few weeks ago. Now, crude oil is up to about $91 a barrel. Brent crude's up to $93 a barrel. So, even just today, crude oil is up over 12.9% this time of recording. Brent's up over 8.9%. So those are some pretty substantial jumps. So again, with oil, with rising prices in oil, that could make people think about potential re-sparking of inflation fears, especially because this last month we did have higher inflation reading month over month than was expected, which brought the first bout of volatility that we had seen in some time. And then obviously the strikes in Iran kind of added to that inflationary pressure, because Iran's saying the Strait of Hormuz, which is a big trafficking channel for oil and trade, they're saying that was shut down and that nobody can go in and out. Now, President Trump did say that they are now escorting tankers through the strait, basically trying to call Iran's bluff and saying, no, the strait's going to be open. So again, as we get through this, we'll get more data and to see actually how much, the supply of oil was affected and so on and so forth. But for the time being, it is bringing uncertainty and volatility to the markets. Now, I think some important things to remember here as we move forward. Okay, we are in a midterm election year, which I do want to touch on real quick as well. At this time, it looks like the predictions are that the Democrats will take the House of Representatives. Again, that is to be seen. We've seen crazier things happen, right? Statistics tend not to matter as much anymore. But, again, just from political analysts that I've listened to, they were talking about it's more than likely that the Democrats could take the House of Representatives, which is quite common in midterm election years. You have one side of the aisle president, and even if they have like a unified government or some of the branches are flipped, one of them usually does flip in a midterm election year. So we'll see what happens. But again, once again, the uncertainty piece I want to touch on is because uncertainty brings about bouts of market volatility. Now, I understand that can bring jitters and nerves, but I just want to reiterate the fact that this is all things that have happened before. We've had geopolitical conflict. We've had midterm elections. We've had oil spikes. We've had interest rate hikes that have gone through the roof. We've had crises. We've had recessions. We've had everything happen. So it's not like this is all a first-time ordeal. We've had tariffs, Trump tariffs 1.0 in 2018, 2019. We had the pandemic. We had Russia invading Ukraine. We had Trump tariffs 2.0, which was Liberation Day this past year in April. Great buying opportunity in the market when that happened. And then we got some great upswing momentum after that. So again, just want to talk about like cumulative returns. If we're looking at, midterm election years, the S&P price index, S&P index price return 1 year after a midterm election, last time we had that was 20%. So after the midterm election year, the average 1 year returns are about 15.4%, which is absolutely remarkable. It's a great market year as a whole. So we definitely take that if that were the case. So again, we might have some continued bouts of uncertainty and volatility as we move through to midterm season here in the fall. But again, there's some really good things and areas of confidence that I do want to focus on here, which we can break down as we move through the year even more in depth. So if you want to hear something, let us know via email or on our socials. I want to touch on a few things real quick here. So let's talk about 5 keys real quick to investing in 2026 in an uncertain world. And I'm hoping this is a silver lining for you guys amidst the bouts of uncertainty and volatility that we've been having. So number 1, okay, bold stimulus could boost the global economy. We're big fans of international investing right now. Pieces of our portfolio are invested internationally. And why? You get the currency play. So, if you get a weaker US dollar or a trending down US dollar, that could boost international returns when converting from those foreign currencies to US dollars. So Also because there's a lot of stimulus going on. You look at, in the USA, we're having more of an easy money narrative, lower interest rates, end of quantitative tightening, QT. Kevin Warsh is coming in as the new Fed chair, which means you're going to have somebody that's going to look at the data and be data dependent and politically independent, right? He's not going to answer to Trump. He's not going to answer to anybody else. He's going to look at the data, be pro-business, pro-market, I think. And we could get a rate cut or two, depending on the data, of course. But that's what we're pricing in right now in the market is a lowering of interest rates this year and even next year, probably more rate cuts next year as well. We've got tax reform. We've got retroactive tax refunds, made in the USA incentives, so more money in people's pockets. And we have deregulation. We got lower government oversight. The government shrunk this past year and continues to shrink, which is a good thing if you like free market capitalism and free societies. We want smaller government. Big government never works. I don't care what you say. That's not a political party statement. That's just a capitalism statement. In my opinion, again, this is my opinion here. Respectfully, I believe that there is no better economic system in the world than capitalism. So, anyway, that's the USA. And then in Europe, we have German fiscal stimulus. So if you look at the German economy, they have a $500 billion infrastructure and defense spending package. They're picking up their share of NATO spending, defense spending. President Trump has asked members of NATO to target 5% of GDP for NATO defense spending to pick up their share. They've been spending around 2%, so an increase of 3%, which not only boosts NATO, but also, again, there's a massive stimulus package going on in Europe, specifically in Germany. Now, if we look at Asia, Asia's interesting. China has a stimulus package that they're pushing through, but there's actually some corporate reform going on over in Japan, Korea, and even in China. They're trying to, a massive push to improve shareholder value, which is great. It's a kind of more Western ideology. Even, you look at Japan has kind of adopted a more friendly regulatory environment for small business and for businesses and corporations to grow and be competitive in the global marketplace. So that's great. That's great. Competition is great in the world, right? That's the whole basis of free market capitalism. And that's why we love it. Number two would be Fed interest rate cuts. Again, briefly spoke about it. Kevin Warsh coming in, hopefully getting some more rate cuts. So Fed rate cuts can be good for stocks and bonds. Why? Stocks, if you're looking at historical, non-recessionary cutting cycles, so if we don't get a recession, U.S. stocks have averaged about 27.9% annualized returns across the past 7 Fed easing cycles. Non-U.S. stocks, international, has averaged 27.5%. Bonds, again, so when yields come down, and like they potentially do in rate cutting cycles, total return for some intermediate term bonds, 16.7%. And cash, even a return of 6.2%. So again, as the yields come down, bond prices go up, good for bondholders. Again, tailwinds for equities, specifically even in the small mid-cap space, easier to borrow money and invest in their businesses. Now, if we do get a recessionary period here in the near to intermediate term in a Fed easing cycle, that does change the return profile picture a little bit. You're looking at, negative 3.5% average annualized return across the past 7 Fed easing cycles, 9.4% loss in internationals. But bonds, again, this is why all-weather diversified portfolio wins the day, 9.8% returns, okay? And cash of 3.7. So again, you want to have something for different market environments and cycles. And that's why we always preach diversification. Don't put all your eggs in one basket. Now, number 3, again, going back to U.S., and then we'll kind of branch out into international and global markets. Company profits are expected to rise worldwide, which is a great tailwind for economic growth for the U.S. and abroad. The estimated annual earnings growth across selected benchmarks. So in 2025, our annual earnings growth was 11.5%, 2026 jumping to 14.9%. Europe, 12.4% earnings growth, 2026 drops to 11.1, but still good. Japan, 8.8 in 25, 9.5 in 26. Emerging markets, which is considered, India, China, Southeast Asia, some countries in South America, Mexico, Brazil, Argentina, countries like that. 15.7% earnings growth in 25 and 18.1 in 2026. And China, negative 2.2% earnings growth 2025. 2026 expected to jump over 13% to 11.2%. So again, estimated earnings growth for this year is looking to be good for companies, which is great for markets, right? Because earnings drive long-term stock price and valuations. Number 4, artificial intelligence. Is it a boom? Is it a bust? Is it a bubble or both, right? It's the question everyone's asking. You saw a big rotation earlier in the year from the big AI tech hyperscalers into kind of more the nuts and bolts of the economy, industrials, materials, utilities, oil and gas. Companies that kind of been out of favor last year have really come back into favor, which is why the Dow actually had a really strong start to the year initially before the recent volatility. So what you really got to look at is, even with all this CapEx, all this capital expenditures that these big hyperscalers are putting in, hundreds of billions of dollars per company, Apple, Amazon, Microsoft, Google, Nvidia, Taiwan Semiconductor, all these companies are putting a lot of money into building out their infrastructure of data centers or product lines or whatever it may be, right? So investors are starting to wonder, will the return on investment be what it's cracked up to be? What's the stock valuations are thinking that they will be, if that makes sense. So basically, if you're paying a higher price for a specific stock, and the run up in that stock has been incredible, and you're sitting there now at this point going, okay, they have less free cash flow on their books. They've spent a lot of money. Are they going to get the return on investment like we think they will? So that's to be seen. But again, I do think you're going to continue to see big tech over the next few years continue to be a bright spot in the market. Even with pullbacks, again, every pullback is an opportunity to put cash to work. So keep that in mind. Okay. Last thing I want to touch on here is, there's always reasons not to invest. I want to finish the video like I started. There's always bad times in the market. 9/11, again, going back to even the early 90s, first Gulf War, 90s recession, the tech bubble bursting, the second Gulf War in 2003, global financial crisis, 2007 to 2009. Again, ladies and gentlemen, I don't have to tell you, there's always a bad time. But what really pays off is consistency, having the long-term view, making sure that you've got your emergency fund set up with your 3 to 6 months of your outflows, your monthly outflows set aside in cash. So that way, if something were to happen, that you have cash to cover your expenses for the short and intermediate term. Now, that's just a general rule of thumb. Each individual person is different. And some of our clients, we keep a lot more cash in hand, setting aside 6 to 9 months or 18 months of income, even if they're retirees. So again, each person's different. But my point being is the same across the board. It's always a bad time. Stick to your principles. Stick to your financial plan. That's what we're here for, is to talk things through with you. But, if history tells us one thing, after every setback, there's a great opportunity, and markets, historically speaking, go up more than they go down. So have the long view. Again, if you have any questions, reach out to Mark or I or the team here at Boyer Financial. We're always here for you to chat with you. But very thankful for everything that you've done for us here. And we'll see you on the next closing bell. Get Mark back on here. But have a wonderful weekend, everyone.